Corporate finance practice problem using Onenote. Present value calculation to estimate stock returns and sale. Get ready, it's time to take your chance with corporate finance. Here we are in Onenote. If you have access to Onenote and would like to follow along, you're not required to, but if you would like to, we're going to be in the tab on the left-hand side. We're in the practice problems. Then down here in the 933 present value, estimate stock return and sales tab. Also note that if using Onenote, you might want to take a look at the Immersive Reader. Many of our presentations will also have a text component down here with the same number that has the transcripts. With this tool, the Immersive Reader, you can convert the transcripts to multiple different languages and either read them or hear them in multiple different languages, making them a good complement to the presentations. So check those out, and if they're useful, please give us feedback on that. Here we have the information up top. We're going to be calculating that information down below in a few different ways. A little bit more complex of a scenario we have. It's a present value type of situation. But now we have a situation where we're going to have investments. We're imagining basically stock investments here. And we're going to have a return on the investments over the next 3 years. And then we're imagining we sell the investment. This could be a similar type of scenario for different types of investments that are going to be more complex than a fixed return. So obviously, if we're putting something into, say, an investment where we're expecting a fixed return, then we can use a present value of 1 or annuity type of calculation for it if it's going to be a standardized system. But if the returns are going to be uneven, then we're going to have to do some combination of the annuities and present value of 1. So here's a kind of an example of that. So for example, if we put in an investment and expect after year 1, we're going to get a return, let's say dividends on it of $100.34, then we can present value that. If we have the year 2, we expect to get a return of $110,047, year 3, $116.21 in terms of dividends coming back after the initial investment. And then we expect to sell the stock after year 3 for $1,055. Obviously, these are all estimates. One way we can do this is we can say, okay, they're not even. Therefore, I'd have to present value each one of these, taking this problem basically into making it into 1, 2, 3, 4 present value type of calculations that we can then add up to get to the end total number of what we believe the present value to be. Another method you might use is if these 3 items were more standardized, maybe I don't know what they will be for the next 3 years, and I will just estimate what I think the return will be in terms of dividends. Then I might use a uniform amount for these 3 items. And in that case, we could still use the same method using a present value of the 4 different cash flows, or we can use basically an annuity if these were all the same for these 3 calculation, an annuity calculation, and then a present value of 1 calculation for this item at the end. So note that you could usually break this type of calculation down to its present value components, and then the annuity would simplify things if you needed to. If you have Excel, then doing multiple present values is not that difficult. If you're doing them by hand, it becomes more difficult to do so. We'll do the calculations a couple different ways. First, we'll do the formula, which will be the more complex way, and then we'll consider how that might be done using like an Excel format and other types of formats as well. So our calculation here, we're going to be doing 4 of these, so this will be kind of a long problem here. We're going to have the present value equals the future value of 1 over 1 plus r to the n. We're going to start with this 1 up top, the 100, which is only a year out. So we put in an initial investment, expect a return after the first year in the form of, say, a dividend of the $100.34. Plug in this into our table type of format. We're going to say we have the 134. That's going to be the future value. Then we have the 1 plus r to the n. That's going to be 1 plus r, which is going to be the 10%. 110%, and we're going to take that to the power of n, which in this case is simply 1 because it's 1 year out. So that's going to be to the power of n. We then have the 100.34 times or divided by the 1.1. That's going to give us then the 91.22. So our return we expect to receive then is the 134, bringing it back to the current day from a year in the future to the present, it being present valued at the 91.22. Then if we do this again for the second one, the 110.47, plug this into our formula. Now we're 2 years out. This is the return we expect after year 2 of the investment. That's going to be the 110 Then we've got the 1 plus r to the n. So we got the 1 plus the r, which is 10%, 110% if we add those up to the periods now, two periods out, 2 years out in our practice problem. So 110 to the power of 2 then gives us the 1.21. If we take the 110.47 divided by the 1.21, that then gives us the 91.30. In other words, after year 2, we expect to receive a return, dividends, 110.47 in dollars, but present valuing those back to the current time period, that's at the $91.30. Next, we go to year 3, where we expect to receive a return of 116.21, and then we expect to sell it for $1,055. I'm going to break these out into 2 separate calculations. We may be able to combine them together since they're both basically 3 years out. I'll break them out into 2 separate items. So the dividend then, we're going to have the 116.21, and same calculation here, 1 plus the 10%. It gives us the 110% now to the power of 3. So that's going to be 1.331. We take the 116.21 divided by the 1.331. That gives us the 87.31. So again, we're going to receive 3 years from now 116.21, which if we bring the present value back to the current day would be the 87.31. Lastly, we got the last one here. We're going to sell the stocks for $1,055. That's going to be in year 3 or after 3 years as well. So we got to present value that one using the same method we did up top. So we're going to say that's going to be the 1,055, and then the 1 plus the 10%, 110%, and then take it to the power of 3 again, which gives us the 1.331. So the 1,055 divided by the 1.331 gives us the 792.64. So we're going to receive in dollars 1,055 after the 3 years when we sell our investment, the stocks in this case. And if we present value it, bringing those dollars back to the current value, that gives us the 792.64. Then if we add all this up for all these items we have, we've got this 792.64 plus the dividend for after 3 years, which was the 87.31 plus, and then the dividend after 2 years, which was the 91.3 plus, and then we had the dividend after 1 year, the 91.22. And that gives these about the 106.247. Note that there is rounding going to be involved if we add those up. So there we have that. Now that would be the long, tedious way of doing it. If you had Excel, you can make this a lot quicker and you'd have the formulas that would look something like this. We're going to have just a series of the present value formulas, present value of 1 formulas, not being able to use the annuity even though there's multiple years involved due to the fact that there's inconsistent or ununiform amounts of the payments that we're having. So it would look something like this. We've got this equals the present value of the rate. So the rate would be 10%, comma 1. This is for the first item up here. So that 100 would be for one year out, 134, comma, because it is not an annuity. And then the future value here would then be the 134. That then gives us magically the 91.22. Then we would do a similar kind of present value for the second item, that being for the 110.47, which is 2 years out. Present value of the rate, which once again would be 6%, comma, now we're at 2 because this would be the dividend for 2 years out. Then comma, because we don't have a payment, it not being an annuity, we take the future value, which would then be that 110.47, the year 2 dividend. That gives us then the 91.30 magically. Then we'll take the third one, the 116.21, do that again. Present value, the rate would then be the 6%. The number of periods now 3, because this is 3 years out. Then comma, because there's no payment. And then we have the future value, which this time would be the 116.21. Note that we might be able to combine these two together because they both happen 3 years out, even though they're different things, one being the dividend, the other being the sale. So then we would do that one more time for the sale. That would be the 1,055 sale of the stock. The rate, once again, 6%. Number of periods, 3 again, because we sold it after the 3rd year after we got our dividend. Comma, because there's no payment, because it's not an annuity. And then the future value being that 1,055. That gives us the 792.64. If we add this series of activities up over the 3-year period, given the 3 amounts for the dividends and the 1 amount for the sale, at the end, we come to the 1,062.46. And we can then make a comparison of this result compared to possibly the initial investment putting in that we basically put in. So now we're going to do the similar kind of process with the tables. So we're at the table time now. So we have the year 1, we had the 100.34, the 100.34, that's going to be at the 10% 1 year out. If we look at the tables then, 10% 1 year out is going to be the 0.9091. So there's the 0.9091, which gives us the 91.22. Then 2 years out, we have this 110.47, 110.47, 10% 2 years out. So we got the 10% and 2, 10 and 2, gives us the 0.8264. So there's the 0.8264. So the 110.47 times the 0.8264 gives us the 91.29. And then we have the 116.21, which is 3 years out. So let's take a look at that one. We've got the 10 and 3 gives us the 0.7513. So the 116.21 times the 0.7513 gives us 87.31. And finally, we have the 1,055 sale of the stock, that also happening in year 3. Therefore, the 1,055 times the same one, we don't even have to look at the table again because it's the same as the last one because it's 3 years out. So that's going to be times the 0.7513, and that'll give us the 792.62. Adding those 3 up, the 91.29, the 87.31, the 792.62, and the 91.22. You thought I was going to miss that one, but I remembered. So if we add all those up, we get to the 1,062.44, similar to what we got up top, close to what we got up top, but slightly different due to rounding because, of course, all the tables, all these decimal numbers here, 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 and there are rounded to 4 digits and are not quite exact, close enough for most decision-making purposes. Of course, for a decision-making purpose such as this, it would be close enough given the fact that this is an estimate, but beware of book problems and test questions that might get really picky to try to force you to use one method or another.